that the unrealized profit is itself a deductible temporary difference, right? So obviously we need to quantify that, and I think I did that to the side here, right? I think I did that to the side here, right? I suppose I could have done it either of two ways, right? In terms of how let me just cut it so that it will be together. Let's it together, kind of closer together, if you want to put it that way, right? So I did it either of two ways, right? Sometimes, for explanation's sake and so on, I may have shown a student a different way of looking at it and so on. So however you wish to look at it, it really does matter. So cost is 100%, profit is 50%, selling price 150. Therefore, you could say 50 over 150 multiplied by the amount that remains in the group, therefore 0.6. Or if you simply look at it, profit, cost, selling price, etc., as we have it here, right? You can clearly see it. As I said, it's the same thing, right? Good. Yeah. Good. So let's continue, right? So we know that the unrealized profit is 0.6 million, and we also know that that is a deductible temporary difference on which deferred tax assets will arise subjected to the recognition criteria. So remember, unlike taxable temporary differences in which you recognize the deferred tax liability on all taxable temporary differences, there are only three exceptions, right? As far as deferred tax assets are concerned, you will only recognize a deferred tax asset on a deductible temporary difference. In other words, the unrealized profit of 0.6 million, if it is probable that future taxable profits will be available, sufficient future taxable profits will be available against which that deductible temporary difference can be utilized, right? So remember that, therefore, right? Good. 3, it says, retained earnings of A at acquisition were 2 million. The directors of cohort has decided that during the year to the date that they intend to list the shares of the company, they will realize, realize is to get earnings through future dividend payment from the subsidiaries amounting to 500,000 per year. Taxes payable on any remittance or dividend, and no dividends have been declared for the year. So the fact that there is no dividends have been declared for the year, it means that we have unremitted earnings, right? So what is unremitted earnings? I remind you, what is unremitted earnings? Unremitted earnings is the investor's share of the post-acquisition profits of the investee. Unremitted earnings is the investor's share of the post-acquisition profits of the investee that it has not yet received in the form of dividends. In other words, undistributed profits. Undistributed profits. And what do you and I know about undistributable profit? We know that undistributable profit will give rise to taxable temporary difference. Undistributable profits or undistributed profit would give rise to a taxable temporary difference. And we have a rule. The rule is that we will recognize the deferred tax on unremitted earnings. We will recognize it on unremitted earnings unless two conditions are satisfied. In other words, if these two conditions are satisfied, then you will not recognize the deferred tax liability. What are those two conditions? One, that in this case, the parent, the investor, controls the timing of the reversal of the temporary difference. In other words, the parent, in this case, the parent, controls the dividend policy of the investee. The investor could tell the investee when they want dividend and when they don't want dividend. After all, that is what is control, right? Control, you could say when you want the dividend, obviously subjected to distributable profits rules as per the Companies Act, etc., right? If you understand, right? So that is subjected to distributable profits rules, i.e. the Companies Act. But the point is that the investor could tell the investee, here what, pay me a dividend. And not only pay me a dividend, how much dividend to pay subjected to Companies Act requirement, right? So does cohort control the timing of the reversal of the temporary difference? The answer is obviously yes. Cohort is the parent of A. And it is probable that no reversal will take place for the foreseeable future, right? So that it is probable that the temporary difference will not reverse for the foreseeable future. In other words, it is probable that they will not receive a dividend for the foreseeable future. This question tells us, on the contrary, that they will receive a dividend. They will receive a dividend. Information from the question. And therefore, it means that we will recognize the deferred tax liability, right? So again, I'm not answering the question, you know, I give you that already, right? Meaning the answer for the question. All I'm doing is analyzing the question, because as I said, I am a big believer in you could read and understand, right? I don't think I need to read an answer for you, because you could read and understand. What I'm doing is I'm interpreting the scenario in the context of the IFRS on the consideration, if you understand what I'm getting at, right? So that's what I'm doing. Again, you all have I've already sent you the answer, right? Good. Part B. It says, Legion was acquired on the 1st of January, 2000, I'm sorry, 1st of June, again, first day of the financial year, right? First day of the financial year. And it's a company which undertakes various projects ranging from debt factoring to investing in property and commodities. The following detail relates to Legion for the year ending to the 1st May 18, right? It says Legion has a portfolio of readily marketable government security. In other words, those are financial instruments, government securities like government bonds. Those are financial instruments. Those were obviously, from the context of Legion, it's a financial asset which are held as current asset. These investments are stated at fair value in the statement of financial position. Well, they should be, because that is a requirement of IFRS 9. IFRS 9 requires that investment in equity instrument, well, we're not quite sure these are equity instruments because they are government security, or investments in debt instrument, right? There are several ways in which you can subsequently measure investments in debt instrument. Either you can carry it at amortized cost, that is if both the business model test and the cash flow characteristics test satisfied, or alternatively, you could carry it at fair value through other comprehensive income, that is depending on the particular business model, either the entity's business model is either to both now, to hold the asset to its contracted maturity and to sell it and to realize the profit, etc. And then alternatively at fair value through profit and loss. So it depends on whether the business model test, cash flow characteristics test, that the only benefit that the entity receives is cash flows in the form of interest and principal on the principal amount outstanding. This is IFRS 9 we are speaking about, right? And obviously something that you should have done at the earlier level. The point I'm making then is that the question tells us it is being carried at fair value. Now, whether it's being carried at fair value through other comprehensive income or at fair value through profit or loss, well, I'm not quite sure that the question tells us that, right? What it does say, they told us, my apology. They did in fact tell us. They said, with any gain or loss, recognizing profit and loss. So in other words, definitely it is being carried at fair value. Oh, look, I have it all to the side here. Sometimes I'm more efficient than I think I am. So if you notice, all of this is what went through my mind, you know, right? Look, I didn't even realize that I had it, to be honest, right? I didn't realize all of that would have gone through my mind, you know, and therefore my extension should go through your mind. Yeah? Not necessarily today, but definitely on the day of the exam, right? So that is how you want to start developing your thought processes, right? This is something that you need to develop, right? Do not get fooled by where someone interpret the entire question for you and say, okay, this is how you get half a mark and a 1 mark, whatever the case may be. And then you never develop that skill set. You have to develop that skill set, because at the end of the day, it is your brain, so to speak, that is writing the exam. If you understand what I'm trying to get at. Yeah. So you need to develop that skill set. Right. So how you do it is, if as yet you don't have it, is you literally train yourself. In other words, you read a line and then consciously you ask yourself, why did they tell me that? What is the implication of that? What do I need to do with that? Etc. You understand? And then you read a second line. As I like to say, it is possible that a single word could have an implication. If not a single word, probably a phrase or a sentence or a paragraph, right? So you should be asking yourself, right? Training yourself in that way, which is that every time you read a question, it is possible that a word, a single word, for example, in this case, it wasn't a single word, it was a phrase, i.e., that the gain, any gain or loss, is recognizing profit and loss. Now, why is that important? Because if the gain or loss was recognized in OCI, other comprehensive income, then the deferred tax will also be recognized in OCI. Where do we get that from? We get that from IAS 12. What does IAS 12 tell us? IAS 12 tells us that the deferred tax, it can be deferred tax asset, deferred tax liability. So the deferred tax amount, deferred tax asset, deferred tax liability is recognized as income or expense in profit and loss. So the deferred tax amount is recognized as income or expense in profit and loss. Unless what? Unless it arises on a transaction, a condition, or an event that is recognized outside of profit and loss. It can be either recognized as part of other comprehensive income or directly in equity. If so, meaning if it arises on a transaction, a condition, or event that is recognized outside of profit, either as part of other comprehensive income or directly in equity, then the deferred tax, the related deferred tax, is also recognized outside of profit or loss as part of other comprehensive income or directly in equity. Right? So what I keep telling you all, this is something that you have to train yourself to do. Nobody can think for you, you know. Always remember that. Nobody can think for you. Unfortunately, right, because of, I suppose, the amount of social media, and you have all of these inverted commas influencers, right? So what is an influencer? An influencer is someone who thinks for you and therefore influences your behavior, right? That's why you have an inverted commas influencer. That's why people are considered influencers, right? So they're thinking, right? Or at least thinking, well, they acted as if they're thinking, and then people just follow along, no? People just follow along, yeah? The point I'm making is you need to think for yourself, right? Always remember, you need to think for yourself. You cannot memorize answers, right? If you want to say it, probably you could memorize what the IFRS say. Okay, I'll admit that, probably, right? But you have to be able to interpret the question and apply the IFRS in the context of that question, right? So please, if it is, by now you all should have already developed that skill set. After all, you all have reached the final level, if you want to call that, of ACCA, right? So therefore, by now you at least should have that ability to, inverted commas, think and analyze and so on, right? Continue, it says, these investments are stated at fair value in the statement of financial position with any gain or loss recognized in profit and loss. These gains or loss are taxed when the investments are sold. So what does that mean? It means, think about it, right? And then it says currently accumulated unrealized gains, 4 million. What they're telling us then, please think about it, right? That's where the thinking comes in, right? And remember, all I'm trying to do is to kind of lead your thought process in a particular way, right? And then for you to do the thinking, well, in other questions and so on. So in this question, the current value is the fair value. The question tells us that. It is remeasured at fair value. The question tells us that. The tax base is the cost. Now, why? How do we know that the tax base is the cost? Because the question tells us that we'll be taxed on the gain, right? It says these gains and losses are taxed when the investment is sold. Let me explain. what is the tax base of an asset? Because this is clearly an asset. What is the tax base of an asset? Because this is clearly an asset. The tax base of an asset is the amount that will be deductible for tax purposes against any future taxable economic benefit derived from the asset, i.e., as the asset realizes the value, as the entity realizes the value from the asset, right? The current value of the asset. The point we are trying to emphasize then is that when you sell this investment, assuming you sell it for $10 million, right? Assuming, then you are not taxed on the $10 million, you know. You are taxed on the gain. Therefore, you are able to deduct from the benefit that you get. What is the benefit that you get? The cash proceeds. The cash proceeds. So you are able, from the sale, obviously. So you are able to deduct from the cash proceeds the cost of it, because you are only taxed on the gain. The question tells us there's an unrealized gain of $4 million. The question tells us, therefore, that there's a taxable temporary difference of $4 million. Obviously, deferred tax liability. Number two, let's say, Legent has calculated that it requires a loan allowance of $2 million against its total loan portfolio. Tax relief is available when the specific loan is written off. Management feels that this part of the business will expand, and therefore the amount of the loss allowance will increase. So if you notice, I have it here again, all commentary. I'm trying to convey my thought processes via writing, obviously. Look, I real writing here, boy. Good. So I have there carrying value, loan receivable, well, I don't know. Tax base for the loan receivable, I don't know. But what I do know is that there's a deductible temporary difference of $2 million. Why? Well, so I have I use a little example to decide. Obviously, that was for the purposes of explanation, right? So I have deferred tax. Sorry, let's say when I lend the money, the double entry would have been debit, loan receivable, credit card. Remember, I'm making up these figures, right? I have made up these figures for the purposes of illustration. And then when I recognize the loss allowance, I would have debited profit or loss and credited loss allowance. In other words, the net carrying value of my loan receivable will be 8 million, i.e. 10 minus 2, right? However, the tax base is 10. Now, why is the tax base 10? The answer is because the tax rule tells us that they only recognize as a deduction for tax purposes. They only recognize you to claim that loss for tax purposes in your tax computation when the specific loan goes bad. When there's a specific loan that is inverted commas written off. In this case, it was not a specific loan. I think it was a general loss allowance, right? Good? And requires a loss allowance. Good. So that was a general loss allowance, obviously, right? Against its total loan portfolio. So they're not a specific loan write-off. The question tells us that tax relief is available when specific loans are written off. This is a general loan loss allowance. And therefore, the point I'm trying to make, therefore, what we do know is that the difference, as I've said, what we do know is that the difference is 2 million, right? And therefore, that's a deductible temporary difference. Good. And lastly, it says, when cohort acquired Legion, it had unused tax losses brought forward, right? So obviously, right away, it's time to talk about unused tax loss and what the IFRS is, right? At the 1st of June 17, it appears that Legion would have had sufficient taxable profit to realize the deferred tax asset created by these losses, but subsequent years have proven that the future taxable profit will not be sufficient to realize all of the unused tax loss. So again, that goes into what the IFRS tells us about what? About the recognition of deferred tax asset or unused tax loss. So the IFRS says, in this scenario, if it is that there is an expectation that sufficient taxable profits will be available at the date of acquisition, which is what they said here, then you're going to recognize the deferred tax asset in relation to the unused tax loss, and assuming that it arose in the financial statement of the subsidiary, I don't know what the tax loss is, that it arose in the financial statement of the subsidiary, then you will include it as part of the goodwill calculation. If it is written in the financial statement of the parent, then you will recognize the deferred tax asset, but it's not included as part of the goodwill calculation. In other words, if the unused tax loss was in the financial statement of the parent, then the double entry at the date of acquisition, when there is no an expectation that sufficient taxable profits will be available, it will be debit, deferred tax asset, credit, profit and loss, deferred tax income. If it related to the subsidiary, in other words, if the unused tax loss was in the financial statement of the subsidiary, and now you are recognizing it, the double entry will be debit, deferred tax asset, consolidated statement of financial position, deferred tax asset, credit, goodwill. Good? And then it says, but subsequent events have proven that future taxable profits will not be sufficient, and therefore, again, the rule of the IFRS. The IFRS says, as at each reporting date, we should review the deferred asset, asset, and if it is no longer probable that future taxable profits will be available, then the deferred tax asset should be reduced. Right? So quite a lot of implication. I remember when I had read this particular question, right? Yeah. Right. So we tell that goodwill is not allowable for as a deduction and so on. So obviously everything that we said earlier. I was unsure, to be honest, whether the deferred tax, it's my apology, whether the unused tax loss was in cohort's book, which is the parent, or in Legion book. Right? I honestly could not, as far as I'm concerned, it's ambiguous now, right? And obviously I've been doing this question a long time, right? I'm not even sure how I interpreted it in terms of the answer that I provide you, but it really doesn't matter, right? I'll tell you why it doesn't matter. Because remember this, right? You are never interested in the answer to this question, you know, right? I'm repeating that. You are never interested in the answer to this question, you know. What are you interested in? You are interested in the principles that you get from this question. That's it. Because this question called cohort, you will never be examined on this in December. Assuming you're right in the exam in December, God willing, you will never be examined. You will never get this question on the day of the exam. But you may get the principles that is inside this question. And therefore, all you are interested in is, do I know the principle? How would I be able to identify it on the day of the exam? And therefore, if I so identify it, then what do I need to say, so to speak, to get my marks? Yes, you are interested in that. But you are not interested in the actual answer to this question, right? At least that's the way I like to think, right? Who cares what is the answer to cohort? Not me, right? I want to know the principles that we get from the question they call cohort, and more importantly, would I have been able to identify those principles, those issues, those concepts? And if I did, do I know what the standards say about those principles, those concepts, etc., right? I think I provided you with the, well, not I think, I know I provided you with the answer this morning, so you can see the answer here, right? You can read it through at your convenience. You can read it through at your convenience, and you will see, inverted commas, everything that we have said, right? I think just looking at it, I think I could see practically everything that we said, right? Practically. Yeah,